Hello, ladies and gentlemen. My name is Thomas Fross with Fross and Fross Wealth Management, and it is my privilege to be able to share with all of you our 2026 annual State of the Markets address. Now, we began doing this a little over 20 years ago with the whole idea of what happened last year in the market, what were the main drivers, not just for the economy, but also the stock market last year. What are pundits saying about both the economy and the stock market for this year? And what are some timeless investment principles that we all can apply to make sure that we have the greatest chance of success? But before we do that, I just want to share with you a few disclosures. If you wouldn't mind, please hit the pause button and read the disclosures, and we'll continue. So just imagine that you've booked a cruise, and this isn't just a small fishing vessel. This is a large ocean crossing vessel. Expansive decks, beautiful restaurants, beautiful rooms, and a great staff to take care of us on the way. And most importantly, a very clear, beautiful destination. Now, when you board the ship, if you have the chance to meet the captain, would you say, well, I hope the ocean stay perfectly calm on this trip? Of course not. I mean, as much as we would like the ocean to be like a lake, in reality, everyone knows that oceans have waves, and some of those waves are small ripples. Some of them are a little rougher than we'd like, and occasionally we have a real storm. Now imagine that ship being your retirement portfolio, and the ocean is like the market. And volatility, well, you guessed it, volatility are the waves. Now here's the important part. No one halfway through a cruise just cancels because there happened to be some storm. Instead, you rely heavily on the captain, because the captain doesn't panic when the wind picks up. He's trained for it. He's navigated much more rough waters in his career. Hopefully he has a Norwegian or a Danish accent, and anything that we will encounter in the Atlantic or Pacific pales in comparison to the way that that captain was trained. Now, it's not that they just put it in cruise control and head through whatever the ocean may throw its way. No, a good captain, they adjust the speed, they may adjust the course slightly if needed, but they keep the ship balanced. They communicate well with the passengers, and most importantly, they keep moving forward eventually to our destination. And that's our role as your financial advisor. See, when the markets are calm and everything's smooth, it's easy to think, well, I don't need a captain, I can do this on my own. But it's not the calm seas that define the journey, it's how the ship handles the storm. In retirement, the goal is not just maximum growth. In retirement, most people's goal is stability, income, protection, and confidence. See, you don't want to be the person running from one side of the ship to the other, screaming because suddenly we came into volatility or the ship is rocking. No, you want a steady hand on the wheel. And a good financial advisor, unfortunately, they can't eliminate the waves because that's impossible. Instead, they help design a ship that's built to withstand the waves. Diversified investments, thoughtful income planning, proper risk alignment, clear communication, especially through the rough patches. And perhaps most importantly, it's the captain's job to keep you focused on the destination, not just every weather report, because temporary waves, they do not change long-term destinations. And the question is not whether volatility will show up, because I assure you volatility will at some point when it comes to investing. But the real question is, who's steering the ship when that volatility arrives? So let's take a look at the ocean, the size of the waves going into last year. And the question is, how did we get here? Well, you might recall when we did our 2025 State of the Markets address, we shared with you what some of the brightest minds in our industry thought the market would do. And just as a reminder, every year the Wall Street Journal does an annual poll, and they ask some of the brightest minds in our industry, whether economists, fund managers, strategists, how they expect the markets to end at the end of the year. Give us some idea of what the stock market, how it might perform. And as you can see here, Oppenheimer at the top, Oppenheimer, Wells Fargo, Yardeni, Tom Lee, Deutsche Bank, they all thought the market, they were quite bullish. They thought the market would do quite well. And on the flip side, if you could see the very bottom, if my cameo wasn't there, you'd see that BCA Research thought the market would end down 25.8%. So there was a pretty big disparity between what someone who was fairly bullish and someone that was fairly bearish thought the stock market how it would perform. Well, how did it perform last year? And the answer is it did quite well. The stock market ended up closing at 68.45, meaning that Oppenheimer was really close. They were a little high on what they thought the market would do, it being up 3.72%. Wells Fargo was up, missed it. They were a little bullish by 2%. And then we look at BCA Research, and they missed it by a long shot. And so the question is, going into 2026 or going into 2025, why was there such a disparity between the bulls and the bears? Well, you might recall that last year during our State of the Markets, we shared with you what we thought the biggest headwind and the biggest tailwind to the stock market would be. Because looking in hindsight, if you would have boarded that ship January 1st and you got off December 31st with a plus 17.5% return on the S&P 500, you said you probably would have thought, well, the ocean was quite calm. But obviously it was nothing of the nature. And what was the biggest bull and bear last year, or biggest headwind and tailwind, I should say? Well, you might You might remember that we shared with you this picture, Donald Trump, because while he was campaigning for a second term in office, he talked a lot about tariffs, and there was a big question mark on how would these tariffs affect inflation. Would they drive inflation up, causing the Fed to overreact and start to raise rates rather than lower them, making lending costs more expensive, and how would that shape the economy? Well, so we knew coming into the year that tariffs were likely, but what we were not ready for was what happened on April the 2nd of last year, and that was Liberation Day. And Liberation Day was a lot more dramatic than what we expected. Rather than a 10% tariff across the board, the White House announced reciprocal tariffs. So in other words, they were going after countries that had large tariffs on the United States, like China. China has a 67% tariff on the United States. So during Liberation Day, Donald Trump announced a 34%. And Vietnam had a 90% tariff on US goods going into their country, and we put a 46% tariff. And you could go right down the list of all of these different countries that would be receiving these, or at least that he announced would receive, and that really shook the market. And if we look at a graph of how the market did at the beginning of the year, we can see how important Liberation Day was. Because what happened was at the beginning of the year, up through about the middle of February, the stock market was doing quite well. Yes, we still heard talk about tariffs on February 1st. Mexico, Canada, and China tariffs were announced. And then on February the 13th, Trump announced plans of reciprocal tariffs, but that was April the 2nd. This was the real shock to the stock market. And it caused the market, if we look from the high point to the low point, the S&P 500 fell about 19%. So we were in correction territory, but we didn't quite hit a bear market as defined as a 20% decline in the stock market. But what you'll notice is that all of the major events the first half of the year surrounded tariffs. Now, after that 7-day real slide in the S&P, then a 90-day reciprocal rate pause was announced, not including China, on April the 9th. And then we come into May the 8th, and then we started to see deals be made. The UK signed a deal with the United States for trade. And then May 12th, China and America decided, let's hit the pause button, let's wait 90 days and see how things go. And so what happened, if we look at the stock market, is it was trading really on headlines, on the news, not necessarily on policy or fundamentals. Now, the reason I say policy, because while these announcements were made, most, if not all, these tariffs did not even go through, despite the rockiness that we saw. So the market was trading on headline risk, not necessarily policy, although policy was announced, and not necessarily fundamentals, because we still didn't know how the market would react or how the economy would behave in this type of an investment behavior. And so, yes, we saw the market decline, but this reminds me of a quote that was actually made by me in 2010. And that quote was, "A momentary drawdown should not derail a long-term investment plan." Why? Because waves occur. That's part of the volatility of being in the stock market. And just because we see volatility does not necessarily mean that that should derail a long-term investment plan. Not if we're ready to make adjustments in our course, in our speed, and not if we keep our long-term destination in mind. And it reminds me of a chart that we've shown you many, many, many times. And that's a chart that shows, going back to 1980, how the S&P 500 performed and what were the intra-year drawdowns. What was the size of the waves that made us uncomfortable? And so as an example, if we go to 1980, at some point during 1980, there was an uncomfortable drawdown. There was a 17% drawdown. But if we were invested from the beginning of the year to the end, we still were up 26%. So A momentary drawdown did not mean that we derail our entire investment plan. And if we look at these red marks, we can see there's been a lot of volatility. The size of the waves have been uncomfortable at times. And if we average them out over the last 46 years, what we see is on average, there's a 14.2% drawdown. So yes, they're uncomfortable, but the majority of the time, 35 of 46 years, the S&P 500 recovered and was positive. The one maybe a lot of us remember is 1987, where there was a 34% drawdown in the S&P 500, and most people forget it. The stock market still ended up 2%. Not that that's anything to jump up and down about, but that is part of investing. So now let's look back at a graph that shows how the S&P 500 did from beginning to end. Now, yes, there were waves at the beginning. Yes, that 19% drawdown that we saw was uncomfortable. But once again, if we held in there, we ended up seeing, not including reinvested dividends, 16.39% growth in the S&P 500. It was really tariffs at the beginning of the year, followed by fundamentals. What were the fundamentals of the economy that most investors were focused on for the rest of the year? And so once again, if you boarded that cruise ship at the beginning of the year, you had no internet access, and you get off at the end and you asked your friends how'd the market do, they would say it did quite well. And well, because we didn't watch it, then we avoided the heartache that went along with it. But once again, it ended up being a very positive year in the stock market. It reminds me of another quote that I can't attribute to myself, but it's been stated many, many times by some of the brightest minds in our industry. And that quote is, it's time in the market. It's not timing the market. It's not timing the market. It's not trying to guess the perfect time just to get out or to get in. Unfortunately, that's nearly impossible. And I'm just going to illustrate that point for you. But let's, for the sake of the argument, let's just pretend that you had the ability to time the market. You have a crystal ball, whatever the case may be. And back in the early 2000s, you saw the market begin to recover. On October 9th of 2002, that's when we hit the bottom of the dot-com bubble burst. And then we began to recover, and we finally peaked out 5 years to the day, October 9th of 2007. And that would have been the point, if we could time the market, to have sold everything and gone to cash. Because what we did not realize was that the S&P 500 was in for a really bad decline. Now, this decline doesn't look that big because it's over a longer extended period of time, but this was a 57% drawdown in the S&P 500 that occurred over the next year and a half, from October 9th of 07 through March 9th of 09. But for the sake of the argument, let's pretend that you did sell at the very peak, October 9th of 07, and you went to cash, and you sat in cash all of these years. You'd be up 22.5% today. You did well, and you never lost sleep because you didn't experience any of that drawdown during the financial crisis. You didn't experience any of the drawdown during COVID or during the Fed rate cut, or would they not cut rates, and what we saw in 2002. And you didn't experience the tariff drawdown. But if you would have been invested the entire time frame, you'd be up 522%. You rode it to the bottom. So once again, if you didn't experience any of it, you'd be up 22.5%. But by experiencing all those highs and lows, because you're invested over a long run, you're up 522%. Timing the market, though, is impossible, because here's the reason why. In order to successfully time the market, you need to bet against every other person who's invested. In other words, October 9th of 07, when we could say there was some irrational exuberance and most people were investing with all they had, that would have been the day that you would have sold when no one else wanted to. And on the flip side, if you would have wanted to buy at the bottom of the market, That would have been nearly impossible because you would have bet against every single bear that had just had their teeth kicked in by the stock market after a 57% drawdown, and you would have wanted to buy that very day. Once again, nearly impossible to be that lucky, we'll call it. But let's just pretend that you made the wrong move, and instead you sold at the bottom, because that's really probably the more probable scenario. Most people don't want to sell at the top. They ride the market down. They know they're supposed to buy low and sell high. Very difficult to do. So most people buy when the market is at its peak and everyone is so excited. And then they turn around and they want to sell October 9th of 2007. That is the day that they SAM out. And if that would have been your strategy, you'd be up 20% today sitting in a money market. If you would have invested that day and you would have bet against every other person in the market, you'd be up 1,290%. Once again, what does this tell us? That we adjust, we don't panic. It's not timing the market, it's time in the market. Now, what really helps us besides time in the market is being diversified. And so what we did in this chart was we looked back at going back to 1989, and we looked at every one-day possible time period, so every single day how the stock market did. Then we looked at every 7 days, every possible scenario. So let's January 1st of 1989, the following 7 days, January 2nd of 89, the following 7 days, and we did every possible rolling 7-day time frame. And then we looked at every 1-year time frame, every 5-year time frame, and every 10-year time frame. And then we looked at it if an investor was all in the S&P 500, in other words, they put everything in stocks, or if they were more balanced and they decided we'll be 60-40, 60% equity stocks blended between large cap, mid cap, small cap overseas, and then 40% would be in fixed income bonds. And here's what we find. For every 1-day time frame, the stock market is a crapshoot. 1-day time frame, the stock market's up 53% of the time. It's down 53% of the time, which is why we tell people every morning you should wake up and know there's roughly a 50-50 chance the stock market could be up, 50% chance it could be down. But notice how those odds start to accelerate over longer periods of time. Over 1 week, we're positive 60% of the time. Over 1 year, we're up, the stock market's up 82. A blended diversified portfolio is up 85% of the time. Let's jump to 5 years. 87% of every 5-year rolling time frame, the S&P 500 is positive. But if we were diversified into a 60-40 blend of stocks to bond, we would have been up 99% of the time. And look at every rolling 10-year time frame. You're up 100% of the time historically, going back to 1989, if we would have stayed diversified between stocks and fixed income. So what's the point? It's time in the market. It's not trying to time the market. And also, there's a real benefit to having some fixed income. We'll call it a little bit of insurance, I like to think of bonds as being like a rudder that goes out of the bottom of a boat. The rudder doesn't make it go faster, but it does keep it from tipping over in rough seas, and that's what fixed income can do. Now, we're not necessarily making any blanket recommendation, because we believe that is investing for our clients, that it needs to be highly customized based on other factors like spending needs and longevity. But this does prove the point that there's a real benefit in being diversified. So that's what happened in the stock market last year. And just a reminder, diversification helps balance out some of the big waves that we know that we're going to encounter. Now, the next question, though, is what are we expecting for 2026? And so what I thought I would do is I would start with just sharing with you the current state of the economy. So as you know, we like to look at the 20 most important economic indicators, and then we look at them whether they're positive, neutral, or negative, and we simply assign them a color. If an economic indicator is positive, we give it green. If it's neutral, we give it yellow, and if it's red, we give it it's a negative. We give it a red color. And just as a frame of reference, I thought I would remind all of you what the state of the economy was back in 2009. So in February of 2009, out of the 20 most important economic indicators, there were only 6 that were positive, 14 were negative. This is a really, really rough time in the economy, and I think we all remember what that period was like. And when we look at the green, what you'll find is that, yeah, there were some positives, but most of the positives weren't really that positive. Like, for example, equity market valuation was positive. Well, yeah, the S&P was down over 50%. Of course, stocks are cheap. Monetary policy was easy. Interest rates were low. Yeah, the Fed had just lowered rates to 0. Fiscal policy was conducive for economic growth. Oil prices were falling and inflation was low. Okay, but look at the major other economic indicators from US economic outlook, global economic outlook. How are jobs and wages, or people spending at the store? I mean, consumer spending does make up 2/3 of our GDP. Housing, business spending, corporate profits, they were all negative. Now, with this background, take a look at where we were at the end of last year, December of 2025. Out of the 20 most important economic indicators, there was only one, and that was stock market valuations. Unlike it was back in 2009 when stocks were super cheap, equities are not necessarily cheap right now. And we're going to dig into that one a little bit later and how important that is. But out of the rest of them, you'll see that there's 6 that are positive, 6 economic indicators that are positive, and the rest are neutral. And some of the neutral are leaning towards being positive. So just a reminder, the light gray, for example, in labor market shows where it was in November of 2025. The black shows where it was in December. But you'll see that all of these economic indicators, most of them were leaning towards positive. And so from an economic standpoint, the economy is in fairly decent shape right now. Now, how about predictions? What are the brightest minds in our industry? What are they predicting regarding the S&P 500 performance? Well, you'll see that some of the economists that were so bullish last year are still bullish, and they're still predicting double-digit performance. If you average all of these out, you'll see that the average analyst is expecting about a 10.7% gain in the S&P 500, where we would end up roughly at 75, 77. So I'd say from an economic forecast and an equity, especially the S&P 500 forecast, the analysts are quite bullish coming into 2026. Now, let's talk a little bit more about tariffs, and I think more importantly, whether those tariffs would be positive or whether what kind of influence that they could have on the U.S. economy. So first of all, what this chart does is it looks at the average tariff rate on U.S. goods back to 1900. And what you'll find is that if anybody says we have high tariffs today, well, clearly they weren't alive in 1900, because we saw significant tariffs on goods coming into the United States. Those dropped. And the fact is, for the last 70 years or so, we've seen lower tariffs, very, very low tariffs until Trump took office. And if you average out the effective tariff rate that started to go up on U.S. imports, what you'll find is that for last year, we averaged a 6.7% tariff. But that doesn't tell the whole tale. That average of 6.7% tariff brought in $174 billion just as of September into the government. And if you look at where we ended the year, the average tariff coming in on imports had jumped to 15.6%, which is about half of where it was back on April 8th of last year. And so what you could say is that this could easily bring in about $450 billion in extra revenue into the government coffers next year. Now, it's important to recognize that tariffs can bring both risks and potential benefits. I want to just talk about some of the possible benefits. First of all, these tariffs can encourage domestic production. So if imported steel or electronics, for example, became more expensive, then it could make U.S. goods more attractive. Why buy it overseas if we can produce it here at a cheaper rate? That can support certain U.S. industries and potentially strengthen employment in those sectors. The second possible benefit is it can reduce dependence on foreign supply chains. And I don't think I have to remind anybody of what we looked at when it came to supply chain issues back in during COVID, where we couldn't get toilet paper, and there were hundreds of large shipping vessels that couldn't even find their way into our ports. Those were supply chain issues that drove prices up significantly. Or right now, what's going on with a potential war in Iran and the Straits of Hormuz. And I can tell you, for one, I don't necessarily want to rely on Iran for our oil. The third possible benefit is it can increase government revenue and negotiating leverage, because what are tariffs? For the most part, they're really negotiating. They're a negotiating tool. They're often not about the tax itself, but about creating leverage to reach better trade agreements. Tariffs can create opportunities in certain sectors, but they can also increase costs, contribute to inflation, and also create volatility. So tariffs can have their upside and their downside. Our job is not to predict policy, because what comes out of Washington from day to day can be completely different. Our job is to position your portfolio so it's prepared either way, regardless of what the market might possibly throw at it. Let's talk about another thing that we feel will have a big benefit, a big influence on the markets coming into 2026, and that is the full benefit of the Big Beautiful Bill that was passed last summer. Now, the Big Beautiful Bill did a number of things. The first thing that it did was it made the tax rates from the Tax Cuts and Jobs Act of 2017 permanent. There was this big fear that tax rates were going to go up, and how would that influence people if they were paying more in taxes? And well, those have now been made permanent, I guess as permanent as the next tax act can be. The second benefit is it raised the standard deduction. It gave a bonus deduction for seniors. The state and local tax deduction increased. It increased the estate tax exemption from roughly $13.5 million per person to $15 million per person. But I want to dig into this a little bit more. When I got into the industry, the most that you could give away upon death without paying an estate tax, or what we affectionately like to refer to as a death tax, was $675,000. So in other words, if you took all of the money that you had, and whether it was the value of your house, life insurance, paintings, all of your investment accounts, your vehicles, everything together, whatever was in addition to $675,000 would have been taxed at roughly close to a 50% tax rate, 45% or so. Now, so imagine how much tax your estate would have to pay, especially when our average client has much more than in assets than that. So what the Big Beautiful Bill did was it said, now you can give away $15 million per person. Married couple can give away $30 million without having to pay a federal estate tax. That was a really big deal for most of our clients. Another benefit that it had was not only for us as taxpayers, but more importantly for charities, was it allowed a person that did not qualify to itemize on their taxes to still be able to write off charitable contributions. Before, it had to be a qualified charitable deduction. So we would take if someone was over the age of 70 and a half and they wanted part of their required minimum distribution to go to charity, then it could go straight to them. But outside of that realm, you weren't able to write charitable contributions off in your taxes. Now it made that permanent. But I just want to outline a few more of the benefits of the big beautiful bill, because when the true impact of these tax cuts are made, when we start to see these coming into this year, we think that that will be a big boom, not just for the economy, but also for consumer spending. So let me give you a couple of other examples. State and local tax deduction went from $10,000 a year through 2025 to $40,000 a year. And then it would go up by 1% a year through 2029. Unfortunately, it would sunset in 2030 and it'll go back to 10,000. We also have the child tax credit. We talked about the federal estate tax exemption, tax on tips. So now waiters, waitresses, people receiving tips can deduct up to $25,000 per year through 2028 on their taxes for tips they received. Overtime pay, they get to deduct $12,500 per taxpayer through 2028. If we purchase a new home, we get to deduct, or I mean a new vehicle, American-made vehicle, will be able to deduct up to $10,000 annually off the interest on our auto loan. There's also a $1,000 now Trump account, which we've been sending information out on regarding that. And we talked about charitable deduction. So think about it this way: with all of this money coming into the economy, we think that that will bode well for the stock market this year. Now, another thing to consider is where we are in the presidential cycle, because when we study presidential cycles, we start to see a pattern on how the S&P 500 performs when we look at volatility, when we look at intra-year drawdowns and performance, positive performance in the years of a presidential cycle. Now, there's some reasons behind this, but typically the first year in office, we have a roughly 15% volatility. You can see roughly a 13, 14% drawdown with about a 12% average performance. But look at what happens on average when we're in the second year of a presidential cycle. You could say, like we are this year, and we're the year of the midterms. Here's what we have historically seen: higher volatility, more inter-year drawdown, and the average performance is less than we've seen in other years, and then it rebounds in the final years. Now, from just this lens, this would be important to us. However, we then had to look at it from the perspective of second-term president. And I know that President Trump was elected, not elected, Biden was elected, and so he's not concurrent to two terms, but nonetheless, this is his second year in office, and so the question would be, how do second-year presidential cycles work? And here's what we'll find: that year two, like we're in year right now, that on average, if back to the first term of a president, we showed you on the last graph, average 8.9% return, but look what happens in year two. Term two, it ends up being the greatest of a second term president with an average of 20.2%. Much better than the following 2 years, and much better than the preceding year. Now, election cycle theory, according to this theory, the first 2 years of a presidential cycle focuses more on political and social interests rather than economic ones. However, in years 3 and 4, attention turns to economic policies as typically the president begins to focus on re-election. Administrations that reach the second term, so that would be years 5 and 6, they typically view being re-elected as an endorsement of their policies. And so they press ahead while not surprising investors. We know what we're getting with Trump. This is no surprise. Returns over the final years are typically more muted as investors and the American public in general start to debate on the next turn for our country. So we found this insightful. We think this is more important than looking at year term one, which we looked at the previous graph. We think that this is more important looking at years two. or I should say second term, year two. Once again, from this lens, this bodes well for the stock market. There's something else to consider, and that is what's going to be the result of the midterm elections that we have coming up this coming November. Now, we find this very, very interesting because what we did was we went back to 1950 and we said when there is a Republican president and the Democrats control the House and the Senate, how has the S&P 500, how is it averaged? How is it performed? Then we said, well, what happens if there's a Republican House and Senate? And lastly, if there's a divided House and Senate between Republicans and Democrats. And what we found is that Wall Street loves, they love grid, yeah, you know what I mean. They like it when the House and the Senate, when there's gridlock. They are more certain that not a lot's going to get done. And when pricing stocks and future corporate profits, it's easier to do so when there's more certainty. And when there's uncertainty, well, then typically the S&P 500 does not perform as well. So from a midterm election standpoint, what is the most likely scenario? Well, if you look at polls right now, the most likely scenario is either Republicans keep the House and the Senate or that they lose the House and retain the Senate. And if so, we don't think that would be the worst thing, despite what some of the pundits on either the right or left-leaning financial news networks might say. We don't think that this is the worst case scenario. Now, how about interest rates? Where do we see interest rates going? Well, what's really interesting when we look at interest rates is, I mean, we know where rates are right now. The question is, what do we feel the Federal Reserve, what do they feel, what direction do they see interest rates going? And so every quarter, the FOMC, the Federal Open Market Committee, they do a poll of all their Federal Reserve governors, and they ask them, where do you see interest rates? And when they were asked back in December, you can see that the majority thought that interest rates would be staying where they were, somewhere between 3.5% and 3.75%, with one dissenting vote thinking that interest rates, we might have gotten a drop in interest rates. Then they're asked, where do you see interest rates going in 2026? And you can see that now we start to see a pattern where these Fed governors are now starting to see interest rates begin to drop, and into 2027, and the majority into 2028, and finally, this is the future. So what does this tell us? Well, this tells us that the Fed, that they are anticipating rates coming down. If you look at what the Fed officials are saying, we average it out, then they're effectively pricing in one cut in 2026. I will say that the stock market in general is pricing in two cuts in 2026. So I guess they don't trust the Federal Reserve. I will say though that after we've had some jobs numbers that have come out over the last 2 weeks or so, and these jobs numbers look quite strong. And this is going to put a lot of pressure on the Fed. One of their mandates is full employment. Right now, we're at full employment. The Fed defines full employment as 5% or less unemployment. We're at that number, and so if we continue to see strong jobs numbers and inflation that's not growing out of sight, then it's going to put the pressure on the Fed to not lower interest rates like the stock market is predicting. I will say that that's not necessarily best scenario, but not necessarily the worst. So if interest rates do stay roughly where they are right now, then does that mean that rates currently are high? Well, what we decided to do is to throw in a chart going back to the 1950s, and we wanted to say, okay, well, what has the 10-year Treasury, what has been that interest rate going back? And I don't have to remind anybody about the late 70s and early 80s. Any of you that happened to buy a new home and had to get a mortgage back then, you'll remember high double digits for mortgage rates. But then we saw those rates drop considerably, and then they stayed at historically low rates, really from from the financial crisis until just a couple years ago, where are we currently sitting at 4.18%. What's the point is that interest rates are higher than they have been the last decade, but that does not mean that they're historically high. And it also does not mean that we cannot see economic growth with interest rates where they currently are. Let's take another look at consumer confidence. Now, consumer confidence, there's a University of Michigan does a study. They do this once a quarter, and they ask investors, are you positive? Are you negative on the outlook of the economy? And this chart happens to go back to 1971. And as you would expect, there are times that consumer sentiment hits peaks. There are times that consumer sentiment hits valleys. But what I want you to just really take into account is that the last 9 times that consumer sentiment was really negative, which should have been where we are now, April of 2020, August 2011. The blue number tells us how the S&P 500 did over the next 12 months. So the last 9 times that consumer sentiment hit a low point, on average, the S&P was up 24.1. The last 10 times that consumer sentiment hit a peak, on average, the market was up only 3.9%. This is a very strong lesson. I was taught by an instructor that he told me, tell all your clients to ask what their friends are doing. Tell them to do the complete opposite. Why? Because most people want to sell when everything is at its worst. They want to buy when everything's at its peak. Consumer sentiment does not have, there's no consistent view of consumer sentiment as giving a view as to where the stock market is headed unless you looked at it inverse. And so when you hear on the news next time someone says consumer sentiment, it's at a really low point, based on this graph going back to 1971, you should view that as a positive thing. So we in our firm, we do not look at consumer sentiment being low as something that we're worried about. Let's take a look at where we are in the bull market. We're now in the 4th year of a bull market that began in September, October of 2022. And what we're doing in looking at this chart is saying, how does the stock market, how has it historically behaved the first year, the second, the third, and the 4th year of a bull market run? Seeing if there was any pattern there. And what you can't see on this last graph is the average. And the average performance of the 4th year of a bull market is 12.8%. Why do we look at this? Do we like to see is the bull market getting long in the tooth? When we've had the market run for a period of time, does it start to give up steam? It run out of steam, and that's not the case. Instead, what we see is the 3rd year historically of a bull market run is a lot less than the 4th, and the 4th is still has averaged double-digit returns. Now, when we were looking at the 20 most important economic indicators, you'll recall that one of them I said that was negative is the price of stocks, or PE ratio, price per earnings. I'll just give you an example. Let's say that you were going to go out and buy a company, and the people selling the company said, here's what we are going to charge to buy the company outright. Now that's important, but not important without looking at their earnings, right? Because if they're asking $100,000 for a company that generates $100,000 from earnings, that would be a really good buy. But if they were asking $100,000 for a company that had $3,000 in earnings, well, that would be very expensive. And so what this graph does is it looks at earnings on this left axis for PE ratio. What is the price per earnings? And the right axis shows the years going back to 1994. Here's what we'll find looking at this graph. Stocks got really expensive, over 24 times earnings in the late 1990s, right before we had the dot-com bubble burst. Stocks were very expensive. Then we went through a real bad market correction, and then stocks were cheap, and then stocks stayed pretty cheap until the financial crisis, and then they bottomed out after that 57% drawdown. This would have been the time to buy. October 9th of 2009 would have been the time to buy. Stocks were very, very inexpensive. Where are we today? A little expensive, 22 times earnings. That when we've only averaged 17.1 times earnings over the last 30 years. So what does this tell us? Stocks are a little expensive right now. But what's interesting is when we look at the concentration of stocks and what are the most expensive stocks. And here's what we're going to find. If we take the top 10 largest stocks, which by the way, the top 10 companies make up 40% of the earnings of the S&P 500. And that's crazy to think about. You take 10 of the S&P companies, the top 10, make up 40%. That means it takes the 490 other companies only make up 60% of the earnings. Here's what we're going to find. When we look at those top 10 companies, the latest PE ratio on those were 28.1 times earnings. So the 10 largest companies, the NVIDIAs and Amazons and Googles, those are really expensive right now. When we look at the remaining 490 companies of the S&P, they're trading a lot closer to historic averages at only 19.2 times earnings. So from that perspective, the overall stock market is not that expensive, but the largest 10 are. The other thing that it tells us is that those top 10 market cap companies, the size of them are also earning the most. So if you look at those, as I said before, I think I said it, and if I didn't, I'm just going to rephrase it. The top 10 companies make up 40% of the size of the market cap of the S&P. They make up 32% of the earnings. So yes, they're big companies, but they also are the greatest earning of the companies. And when we look at those companies, which are mainly the information technology companies, what we'll also see is that their earnings growth is the highest. Now, if you're buying a company, you want to look at their previous years and say, month over month, year over year, is your earnings growth getting larger? Are you getting a larger percentage of earnings? And here's what we'll find is that those top 10 companies are the companies that are earning money right now. The earnings growth is huge, 25.9%. The second largest sector in earnings growth is materials at 9%. But then we drop all the way down to consumer staples at less than 1% earnings growth, healthcare 0.2%, industrials negative 0.5%, consumer discretionary negative 3.5%. So yes, it is true that the top 10 companies, that their PE, price per earning ratio, is higher, but in our opinion, their earnings justify it and their earnings growth justifies it. And if we look back at the other 490, they're not nearly as expensive as what the stock market would portray. What this chart does is it just simply looks at the return of the equity. So it's every dollar of profit per outstanding share. And what we start to see is that this is what the S&P 500 as an average is, okay? And look at the price on equity and price as opposed to book by sector. And you'll see how low these others are, but look at how high information technology is. So that's what's been really the driving force behind the S&P 500's performance, and also how expensive they are. But we feel that as a whole, stock prices could be more expensive than what they are. And this is not something alone that has us concerned. Now, does it mean that we are not looking at a bit of a correction to get those prices down? Because what can help price per earnings? Either price comes down or earnings go up. Simple. Is it possible that earnings of these companies could begin to accelerate from these other sectors? Absolutely. Or we could see a price decline, which could make the PE ratio much more attractive. One thing that, if you'll notice within most of your portfolios that we've been doing, is shifting more towards more of your funds towards overseas and emerging markets rather than just here in the US. And the reason why is because, yes, the S&P 500 is expensive, the purple being where it was currently, blue is where it was at the beginning of last year, so prices have only gone up. But look at some of the deals when we look at Japan, Eurozone, emerging markets. This last graph happens to be China, but we're seeing stocks at overseas significantly cheaper than what they are in the US. And what's also interesting is looking at the 20-year average of where those stocks have priced. And so, yeah, the 20-year average is about where it is on some of these. But the range, we could see other sectors or other areas across the world get much more attractive. And we look at the stock market's performance this year, what's been the driving force has been overseas and not been domestic. I want to make sure before we conclude, I want to talk about Venezuela a little bit and the impact that could have on the market this year. Now, this graphic, if you've been watching the news, this is very elementary to you, but I think that you've probably seen that, first of all, that if you look at that the Venezuelan crude production or the proven oil reserves that they have. Let's look at the chart on the right. The proven oil reserves as a percentage of global oil reserves, Venezuela makes up nearly 20% of it. I mean, I always joke you can almost stick a straw in the ground in Venezuela or Saudi Arabia and oil starts pumping out. And what you can't see on this chart is the United States, which is all the way over here. So we do not have a lot of proven oil reserves. However, look at what happened with Venezuelan oil production. So it was still averaging not very much at around 2.5 million barrels per day until after Maduro was elected. And if you wonder what socialism and corruption can do to a country, just look at what happened to their crude oil production. It dropped like a lead balloon. The latest realized level was less than $1 million barrels per day that were being produced. But I want to put that in perspective for you. The United States is producing 13.3 million barrels a day, as opposed to less than 1 million with Saudi Arabia. Saudi Arabia, 9.2 million barrels a day. Russia, 9.2 million barrels a day. Canada, 5.1 million barrels per day. And then once again, we dropped to Venezuela, 0.93. What does this tell us? Well, when Venezuelans' oil finds its way back into production and finds its way into the overall global scene, then this could drop oil prices significantly, which we think would be good for the stock market moving forward. Now, could there be another geopolitical risk event that occurs? I would be shocked if there won't be one. We call these maybe black swan events. And what we did in this chart was in the illustration was just to say, if we go back to 1973 and we looked at the major geopolitical events that have occurred since, like the Iraq War, 9/11, First Gulf War, Soviet invasion of Afghanistan, Russian-Ukraine war, we said, well, how on average, how many days does the stock market sell off? On average, 11 days. Typically, it's a 5.3% decline in the S&P 500. And then how many trading days does it take to get back to where we were? On average, it takes 12 days from the bottom. And so this is not a nightmare scenario. I will say it gives the pundits, the talking heads, a lot to talk about, no doubt about that. But historically, it's had not a very large influence on the direction of the overall stock market. One of the ways that we help make sure that we're able to account for different time periods and how conservative or aggressive we are is making sure that as we're investing for you, that we're keeping some funds that are conservative, money that you need now. Typically that's like over the next 3 years. Then we start to introduce risk on money that you need for income over the next 4 to subsequent 7, 8 years. And then finally, money that we put away for the long term, money you're not going to need for 8, 10 years plus. We, in our strategy, we keep this bucket of money conservative, start to get more aggressive, and then finally aggressive so that we have a hedge against inflation. This is a time-tested strategy to make sure that we're not taking on too much risk and that we're taking into account longer periods of time and how that balances the market risk out. In conclusion, I just want to start by telling you a quick story. And yes, it starts with a children's fairy tale, but stick with me, I promise that there's a point. Now, we all remember the story of the 3 little pigs. One built a house using straw, one used sticks, and one took his time and built his house with bricks. And when the big bad wolf showed up and started huffing and puffing, well, there was only one house standing. Now, what I thought would be fun is just to do a grown-up version of that story, but let's call it the 3 little investors because this plays out in the real world all the time. So meet investor number 1. We'll call investor number 1 Kevin Bacon. Now, Kevin wants fast results, so he builds his portfolio out of financial straw. Whatever's hot in the headlines, artificial intelligence stocks, crypto, trendy ideas from social media or cable news. And for a while, Kevin Bacon feels like a genius. Markets are going up and his accounts look great and life is good. But as typically happens, the wolf shows up and suddenly we hear about bubbles, regulations, valuation concerns, market volatility, and the same things that push markets up start blowing the other way and we see things decline. Now, because Kevin's portfolio is concentrated on concentrated and built on hype, it collapses quickly. He panics, he sells at a loss, and he decides the market is rigged and I'll never invest in stocks again. So what's the lesson? Straw portfolios look great right until the wind blows. Now, investor 2, we'll call her Rosita. Rosita's more responsible. She knows that she shouldn't chase every trend. So she invests in a US stock index, a broad index, hundreds of companies, much better than straw. And again, for a while, things work out just fine. But when markets get choppy, as they typically do, interest rate risk, trade headlines, election noise, well, Rosita begins to get uncomfortable. She doesn't have a clear risk plan, so fear takes over. She sells to stop the pain, and then unfortunately she watches the markets recover without her. What's the lesson? Sticks are better than straw, but without discipline and risk management, they can still snap. Now let's meet investor number 3, and we'll call him Wilbur. Now, Wilbur brings in a professional. Together they talk about goals, income needs, and most importantly, how much risk actually makes sense for his stage of life. They build a brick portfolio, one that's diversified, balanced, one that's designed for long-term retirement needs, not just headlines. And when volatility shows up, inflation worries, global uncertainty, questions about technology, Wilbur's portfolio does wobble a bit. That's normal, but it holds. He stays invested, he sleeps better, and he gives the market time to recover. What's the third lesson? Bricks do not prevent storms, but they help you survive them. Now, here's the question that I want each of you watching to think about today. If the big bad wolf showed up tomorrow, which one would you be? As a client of ours, we built you a brick portfolio, one that's diversified, balanced, and designed for long-term retirement needs, not just headlines. And I assure you, the big bad wolf will show up. The winds will blow. but our portfolios are built to hold. They were built to help you sleep well at night so you can live out the rest of your retirement with confidence. So what's the point? Rely on us to help you build a brick house. I've got to tell you, it is a privilege to be able to work for all of you. On behalf of all the advisors that are here at Fross and Fross Wealth Management, thank you very much for watching this. It's our pleasure to give you our thoughts on the economy, the markets, and how we're personally working to protect and grow your wealth. If you have any questions about anything that we talked about today, please feel free to reach out to anybody here at our office, any of our financial advisors, and we'd be more than happy to help you. So once again, on behalf of everyone at our firm, thank you for watching. Enjoy the rest of your day.